Welcome everyone, and thank you for joining me for another market recap video. Now, we are in a very interesting market environment because although we are sitting just within touching distance of all-time highs here at around 309.99, the market is very choppy from an active trading standpoint because of this fairly sideways range bound action. So as you can see, we have a clear ascending channel here, very well defined, very well defined ascending channel. And for the past week or so, we've been ranging between this low here at around 307 and the extreme highs at around 310. And so from an active trading point of view, there is very little opportunity when it comes to identifying asymmetric risk to reward opportunities. Being so close to all-time highs, one would think that the risk is to the downside in terms of a mean reversion trade. However, given the fact that in the longer time frame, if you look out here, in the longer time frame, on a weekly time frame, we have actually broken out from this nice consolidation here that we've been doing for several months, which in itself was a broadening wedge formation. We've broken out from this flat top here at around 303. And so what we have here is a definitive market move to the upside. And there has been demand coming in from all areas of the market to support the validity of this upward push. And so being short is not the greatest idea at this point, although we are a bit extended given the recent run up within the last 2 weeks or so. What has happened is that we are having rotation from growth into value and then value back into growth. And so this is keeping the indices or the overall index elevated while individual names suffer small pullbacks that are then bought up, and names that have been overextended are being slightly sold off. But as soon as they come into any sort of real support, the buying pressure comes back again. So let's begin taking a look at a few names to illustrate this. So we have, of course, Apple breaking out to all-time new highs. As you can see, if you go back on a weekly chart here, and of course, Apple being the largest company by market cap, it has dragged the indice right along with it. So you can see we have a nice breakout here at around the 234 level, and Apple has not looked back since. So given the strength in Apple, one would have to use that as another data point to build conviction for the long or the bullish case. However, it is very difficult to get long Apple at these levels, given that it has been up now 1, 2, 3, 4, 5, 6, 7 straight weeks in a row. Granted, that has come with higher volume, so we do see price move being validated by strong volume demand. However, in terms of an asymmetric risk to reward opportunity, it simply is not there to the upside. And so a lot of more experienced market participants like myself are waiting for an opportunity to go long. But I would suggest for those of you who do have portfolios and you do have stocks like Apple, and for example, now would be a good time to begin selling some call premium on your positions, possibly 3 to 4 months out at the, let's see here, at the at around the 275 level, just so that you can earn some extra premium. And in the event of a continued but very slow market push, you're able to benefit on the upside from both your stock appreciating as well as the theta decay in your options that you sold. Let's take a look at Google. Google again, following Apple's footstep, has broken out to an all-time high, and it is just simply hanging around at the top of its range. And so from an active trading point of view, this is particularly frustrating because you've gotten the breakout, but you've had no real momentum and follow through to the upside. And so this is an ideal case scenario for using the option premium collecting strategies to your advantage, because you can simply sell puts at the low of this existing range and then just let time do its thing. If you are in a rush in this particular market environment, then you are more likely to put yourself in harm's way, as the asymmetric risk to reward opportunities simply are not there. And so sometimes when there's nothing to be done, what is to be done is to simply sit on your hands. This is how more inexperienced market participants, quite frankly, get their butts handed to them because of impatience when the market environment is not supportive of great risk to reward opportunities. Let's take a quick look at Amazon. Amazon seems to be the black sheep of the tech family at the moment. Let's see whilst this loading. While everything has gone on to test its highs or break out to new highs, you can see Amazon is a completely different story. So we have the all-time here at 2035, made all the way back in around July. And since then, we've had a solid sell-off, and we are being trapped in this sort of clearly defined range here with a high at around 1840 and a intermediate low at around 1750. But we also have this low at around 1685 to possibly contend with if we do not hold above these converging moving averages. You have the 200-day moving average here at 1806, the 10-day at 1783, and the 50-day at 1775. And so if we cannot get above that 1775 level, I would say within the next couple of days, we can see some explosive fireworks to the downside, probably firstly contained by this 1700 level, and possibly further downside if we see any great weakness enter the market. However, I would not be getting all bared up here on Amazon. It has proven itself to be a market leader for quite some time, and funds will be getting interested at these levels. And so what might be a trade to consider would be looking out a bit further. If Amazon does indeed pull back to that 1700, 1685 level, a nice trade would actually be to sell around the 1625 put spread, just so that you can take advantage of Amazon hanging around in this area for a bit more time. I would do that looking for at least the January monthly expiration, those 1625s. That would be a really nice expiration. Let's take a look at some of the high beta Netflix. So Netflix has been a bit of a laggard, to be fair, this year. It started off really nicely, making moves off of the lows from around 230 all the way to around 385. had a double top here, as you can see, at around 380, and has been selling off and consolidating since then. And so for me, this one is a tactical long if it comes into support at around this 266 level. But besides that, I would probably be selling wide width iron condors on Netflix, looking to the January expiration at around the 320 and 250 level on the downside. Let's take a look at some value names. Verizon. Now, look at this. This is why the indices and object lesson and why the indices have been holding up so well, because even the defensive names with with high dividend payments, so to speak, even these names have held up remarkably well in what seems to be a now risk on environment. And so there is very little adverse effects being yet felt by different sectors within the trading economy, for want of a better word. If you take a look at stocks like Honeywell, industrial stock breaking out to all-time new highs. KSU, again, Kansas City Southern, railroad transport breaking out to all-time new highs. You have, let's take a look at some defensives. You have Raytheon attempting to test all-time highs. At 229. Meanwhile, you have things like Walmart breaking out this morning again to an all-time new high. And so when you have these names showing the type of strength that they are, you have to be taking your cues and signals from what the market leaders are doing. And the market leaders thus far are either breaking out and holding all-time highs or attempting to test all-time highs. So clearly there is a bullish bias to the upside. And so whilst the trader in me would love to be playing mean reversion and looking to position short, that has to be in a very tactical way, because otherwise you're going to get your ass handed to you, quite frankly. Let's take a look at T. Again, you can see defensives attempting to test the highs of the range. This is a very not strange market environment, but it is a very tricky one for active traders. And so the less that you are forced to do at this time, the better. Sit back, wait, watch, observe. There will be opportunities that come as time sets up, whether the market comes back into some sort of intermediate short-term support. Let's pull this back to 20-day, 1 hour. So for example, if you are coming back into the lows of this range at around 306, then by all means, you can look to be positioning long, but I would not be heavily positioning short at this point. A tactical short perhaps on a retest of 310, by all means, I'll probably get into that with a very tight stop at around 310.50. But besides that, it is simply a sit on your hand and wait sort of market for the best types of risk reward setups to present themselves. All right. Be safe out there, guys. Cheers.